Hi, I'm Greg Hunter. Welcome to USA Watchdog. With us once again, a best-selling author. He wrote this book, and it's a winner, The Death of Money. If you guessed James Rickards, you guessed correct. James Rickards, thank you so much for joining us today on USA Watchdog.
Thank you, Greg. Great to be with you.
Well, I want to just first start off with, the most topical stuff, and that is ISIS. It looks like there's another massacre brewing in Kobani in Syria. What do you think about the whole ISIS situation? Some people say the U.S. and our allies, Saudi Arabia and Kuwait, have, including the vice president, have helped armed, these folks.
Well, I don't call them, first of all, Greg, I don't call them ISIS or ISIL or anything else. I call them the Islamic State. And the reason I do that is because that's what they call themselves. So they call themselves the Islamic State. Of course, that's an English translation from the Arabic Khalifa, which in English would also mean caliphate. So as far as they're concerned, they have reestablished the caliphate. The last caliphate ended in the early 1920s with the final decline of the Ottoman Empire and the abdication of the Sultan. And then prior to that history, there were other Abbasid and other caliphates, through the Middle Ages. So this is a new caliphate. There's nothing new about this, by the way. Islam has been establishing caliphates since the 7th century A.D. This is just the latest in the long string. It's part of their plan for global domination. Their theology is that you either convert to Islam. They do allow what they call people of the book, which are Christians and Jews, to submit. As you don't have to become a Muslim, but you have to submit to their authority, keep your religion to yourself, and pay a tax, or they behead you, they kill you. So that's, what they're doing is according to their scripts, and none of it comes as any surprise. What is a surprise is how unprepared the United States was for the emergence of something like the Islamic State, and the weakness of our response. Now, as far as who armed whom, the easiest way to understand politics in the Middle East, I know it's a cliche, but it's one of those cliches that happens to be true. The enemy of my enemy is my friend. And so you have a lot of situations where people are providing arms to others who might be their enemy because they think they'll turn on somebody else who's an even bigger enemy. So going back several years, President Obama said he wants to get rid of Bashar al-Assad, who's the president of Syria. And the question is, would any weapons go to rebels? They weren't coming directly from the United States. There was some training and some special operations going on, but we weren't supplying them a lot of weapons. But the Saudis and others could and did supply them with weapons. But most of the Islamic State heavy weapons were captured when they invaded Iraq. It was U.S. equipment that we left behind when we pulled out the troops. We left our equipment behind. That equipment was in the hands of the Iraqi army. The Iraqi army threw down their arms, stripped off the uniforms, and ran away from the battlefield. And the armored personnel carriers, the tanks, the Islamic State's running around with tank battalions. You don't get tank battalions on the internet. You get them by, sort of capturing the enemy. So the weapons have come in the past from Saudi Arabia and other Arab governments who wanted to topple Assad on the enemy of my enemy is my friend theory, as well as what they captured from U.S. weaponry left in the hands of the Iraqis who would not stand the fight. So that's where the weapons are coming from.
Well, could this be, something that drags the global economy down? I mean, if these guys they don't have aircraft carriers, and right at the moment, they don't have an air force, but could this, spread globally? They say they have fighters around the world now.
Sure. There are two ways that this could impact the global economy in a significant way. One is what we call a spectacular terror attack. Now, all terror is bad, and the idea of terror is to terrorize people. In other words, there might be a particular beheading victim, but the purpose of beheading somebody on a city street in London or New York is to scare everybody else. That's what terror is. So it wouldn't take much. We've already had an Islamic beheading in the United States. That's the other thing. Our government seems to be in denial about what these things are. It was revealed the other night that the Fort Hood shooter sent a letter to actually address to Pope Francis. It was released by his lawyer, basically declaring that he was part of the jihad. So why the Pentagon calls that workplace violence is a bit of a surprise. And then this other guy who beheaded the poor woman in Oklahoma, I believe, that's classified as workplace violence. But he's clearly a radical Muslim. So the terrorists here, the beheadings are taking place. So if there were more of them, or certainly anything like, but that's sort of street violence. That by itself will terrorize people, but it won't take down the markets. What would take down the markets is some kind of large device, a bomb, radiological device, other kinds of asymmetric warfare on a large scale. But that's probably coming because we know they're trying. So that's one thing. The other thing, of course, is any disruption to the flow of oil. Now, the United States does not get much oil from the Middle East. We get our oil from Venezuela and Nigeria. In domestic production, the U.S. is very close to being a net exporter of energy, so we're not dependent on that. But it's a world market and a world price, and China is dependent on Middle Eastern oil, and Europe, to some extent, is dependent on Middle Eastern oil. So if the Islamic State spreads and begins to disrupt the flow of oil, either in Kurdistan, northern Iraq, or southern Iraq or elsewhere, invade Saudi Arabia, that would have an enormous impact on markets. We've seen the price of oil drop like a stone lately because the world's in depression and there are deflationary fears, but that could turn around on the geopolitical vector. There are three things that affect oil prices. One is normal supply and demand, one is geopolitical, and the third is inflation and deflation, sort of monetary policy independent of fundamental supply and demand. Right now, the supply-demand equation is slowing down because the world's in a depression. Likewise, monetary policy has given us not inflation but deflation. But the geopolitical vector is a wild card, and that could go up. So yeah, this could definitely impact global markets either through a spectacular act of terror or disruption in oil supplies.
Next up, Ebola. Boy, that's a black swan that came out of nowhere. All of a sudden, boom, we are looking like that we could have a global pandemic. And they've said, oh, there are very little chances of getting to the United States, and voila, the guy in Dallas, and now the head of Human Services, oh, there might be, more victims, more Ebola people who have been infected by Ebola here in the U.S. Yeah, you think? So could this be could this crash the markets? Could this, be a big problem for humanity? I mean, the IMF says it's right now $32 billion to fight this problem.
Well, look, it's a big problem. The result, kind of remains to be seen. When I think of black swans, I don't particularly like the phrase black swan because it's sort of, it was Nassim Taleb's phrase, and he sort of threw up his hands and said stuff happens. Taleb, in his book, The Black Swan, did a very good job of demolishing the bell curve and demolishing the idea of normally distributed risk. So I agree with that completely. That needed to be done. I thought he did a great job. But then he got that far, threw up his hands, said, math doesn't work, models don't work, stuff happens, go long volatility, and good luck to you. I'm a philosopher, and kind of walked off the stage. I never really accepted that conclusion. I thought that there are models that could work, and there are ways of quantitatively and rigorously and scientifically understanding risk in capital markets. But so black swan to me is a little bit of a content-free phrase, but black swan, to the extent you want to use that, I prefer the snowflake and the avalanche. The avalanche is the embedded risk. The snowflake is the catalyst, but the snowflake is too small to see. You never see it coming. You just find out the village got buried by the avalanche, but you never see the particular snowflake that caused it. But that's the same. That's a complexity theory analysis. It's the same sort of mathematics behind that. But it's always the thing you don't see coming, Greg. Ebola could get a lot worse. It could have a large economic impact. But we see it coming. Anyone who doesn't understand that this could be a pandemic, that it could spread, to Europe, to other parts of Asia, to the United States, sort of not paying attention. So markets tend to discount that. The thing that'll take down the markets is the thing we don't see coming. So what could that be? An assassination, a failure to deliver gold by a major bullion dealer, some financial collapse of an MF Global type that no one saw coming. Those are the things that are more likely to turn markets on down. Markets may collapse on their own for reasons that are very hard to see just because of changes in psychology and the adaptive behavior of investors. But to the extent there's a catalyst, it's probably one that we won't see coming.
Well, in one of your most recent commercials, your infomercial, which I got to tell you, is one of the best ones I've ever seen, and I'll tell you why.
Thanks.
Because it gave real information. And I'm not trying to pitch your book. I mean, I'll pitch your book anyway because it's what you did and it's a bestseller, Death of Money. But you're worried in this commercial, which I'm sure was done several weeks ago, about how close we are to that snowflake moment, which I love, incidentally, of that, could cause the avalanche. How close are we? Let's get into timing here. How close are we to the, as you say, snowflake moment?
Well, if you want to be scientific about it, Greg, and stick to the science, which is what I like to do, the answer is we don't know. In other words, it could be tomorrow. It could be 3 years from now. I don't think it's 10 years away. I don't even think it's 5 years away. But it's not necessarily tomorrow, but it could be. In other words, maybe a snowflake will start an avalanche, but maybe it'll just pile up more snow. And it could pile up and pile up and pile up. Now, what's happening is that, everyone's waiting for some blunder down the road, and the point I try to make is the blunders have already been made. The blunders are already built into the system. You can see this collapse coming a mile away, but what we can say is that the longer it goes on and the larger the system gets, and when I say the system, I'm talking about concentration of bank assets, the size of derivatives books, the interconnectedness, what's called the density function of the financial system as a whole. The greater that gets, the larger the collapse when it happens. So we cannot, using the science, we cannot say very much about the timing, but we can say a lot about the magnitude. And what that reveals is that this will be the greatest financial collapse in history. So I feel quite sure about that, but we can't be sure about the timing. But what I say to investors is, why wait? What are you waiting for? People think that, I can call them up at 3 o'clock in the afternoon and say, tomorrow's the day, sell your stocks, buy some gold. It's all good. I can't do that. I don't know what day it's going to be. And by the way, if we get to that point, even if you knew it was going to be tomorrow, it would probably be too late to act. So the time to act is now. By the way, on top of everything else, on top of the threats you mentioned, Greg, from Ebola and the Islamic State and the normal currency wars and the normal depression that the world is in, there's financial warfare going on right now. We've put sanctions on Russia. You think Russia is just going to sit there and take it? Russia is responding asymmetrically through cyber warfare. At the end of July, Bloomberg Business Week ran a cover story called the NASDAQ hack that revealed that the Department of Homeland Security and FBI found a Russian attack virus embedded in the NASDAQ stock market in 2010. Now, I was just sitting there waiting to be activated. This wasn't some criminal gang or people trying to steal your credit card or identity theft. This was the Russian state preparing to take down our markets. They're entirely capable of that if we ratchet up the pressure too far. And I don't think we will, because I think we're probably smart enough to understand what I'm describing. But if we ratchet up the pressure too much, Putin will just close the New York Stock Exchange. So investors will wake up, you'll have your 401ks, your stock portfolio, your mutual funds. All of your so-called stocks will become private equity because you'll still own them. You just won't be able to trade them. See, the problem in a boom, in a bubble, which we're in now, people think everything's money. You think your stocks are money because you can sell them and get the cash in your account in a couple of days. You think your money market funds are money because you can call your broker and get the cash in your bank account tomorrow. You think your house is money because you can take a second mortgage or sell the house. So what you find out in the panic is that all those things are not money. You're locked in, locked down, can't get them. The only thing that's money is money. That would be cash if you happen to have it, or gold or silver. If you have it in physical form, not paper gold. So people don't really understand what money is until everyone wants their money back, and then you find out that only a small number of things are actually money. So if Putin shuts down the stock exchange, let's just look at August 22nd, 2013. The NASDAQ stock market was closed for half a day. That was a year and a half ago, almost a year and a half ago. We've never received a credible explanation as to what happened there. It suggests to me that it probably was some kind of military attack, and they don't want us to know that, because if people understood that risk, they'd pull their money out of the stock markets. That's why they're not telling us.
Well, I got to talk to you when you say take action, and I find it, I've told people the story about it. I say, Jim Rickards told me something amazing, and his friends, and your friends are and people you are with, and I'm not trying to, have this two-tier system or whatever, but your friends are different than most people's friends. You consult for governments. You know very wealthy people. You consult wealthy people, and that's not a bad thing. But for them to say to you, hey, Jim, tell me the day before this happens, I'm like, wow, that's a stunning lack of grasp of how serious the situation is to me. And when you say take action, you're talking about going out and buying gold and silver and having some cash. Is that what you're talking about?
Of course. Not all of it, not 100% of your portfolio. And that's not well understood. I say maybe have 10% of your portfolio in gold, have it in physical gold. And then the price of gold goes down, and, these people on Twitter or whatever, they're like, oh, you're an idiot because you recommended gold and gold went down. Well, look, I recommend 10%. If you have 10% of your portfolio in gold and gold goes down 20%, that's only a 2% decline in your portfolio. Meanwhile, you should the other 90%, in my own portfolio, I have an art fund, I have alternative investments, I have some cash, I have land, I have other things that are doing just fine. And so, that kind of real diversification is the key. A lot of people, they'll go out and buy 100 stocks in 10 different sectors, and they'll tell you they're diversified. They're not diversified. They may have 100 stocks, but they're in one asset class, which is stocks. And the stocks are commoditized these days, and they'll all go down at once in a panic, or if they shut down the stock exchange, they all get frozen at once. So that's not diversification. You can have some stocks, some land, some art, some silver, some gold, some cash, have all of these things, and if one's going down, the other one's going up. But when the time comes, when the day comes, when everything else is going down and gold's going up, 2, 3, 4, 500%, that's when you're going to be happy to have the 10% gold. So that's the way to put it in perspective. But I absolutely do recommend that for a part of the portfolio, and I want to emphasize part, because the thing I like about physical gold, Greg, a couple things. Number one, it's not digital. You can't wipe it out with a few keystrokes. It doesn't get wiped out in the cyber war. Number two, it's not something where you're depending on anyone else. In a financial panic, it could be very easy for the government to reprogram all the ATMs to limit you to $300 a day. And they'll say, look, $300 a day is enough for, gas and groceries. So that's all we're going to let you have. We're not stealing your money. We're just freezing it. And you can go to the ATM, but you can only need $300 every 24 hours. Are people ready for that? Probably not. So you probably want to stack whatever, $5,000-$10,000 in cash, so you're not subject to that kind of lockdown by the government. By the way, if you notice, since 2008, the 5 largest banks in the United States have a higher concentration of all the banking assets. So everything that was too big to fail in 2008 is bigger today. Now, obviously, that entails a lot of risk. If you understand, again, going back to the earlier part of the discussion about complexity theory, that increases the risk. So why would the government do that? Well, the answer is, it's kind of like herding pigs into a pen before you slaughter them. It's easier to get them all into one pen. By herding the savings of the United States into a very small number of banks, it makes it easier to lock down those banks so people can't get their money. So whereas if there were hundreds of large banks, it'd be very hard to chase around 100 banks and people would be, running from bank to bank and all that. But if you have a very small number of super ultra large banks, it makes it easier to lock down the system. So that's the kind of thing that's going on. I think most people are oblivious to it, but we've seen it around the world. We've seen it in history. A lot of people don't know that. And if you tell people that there was a time not that long ago when the Secretary of the Treasury called the New York Stock Exchange and closed the New York Stock Exchange for 5 months. Are you aware of that? I think most people are aware of that.
I did not know that.
Well,
was that back in the early 1900s?
It did. It happened on July 29, 1914. Secretary McAdoo, Secretary of the Treasury, called the New York Stock Exchange. They closed it down, did not reopen until December. Now, you can say it's 100 years ago. It would never happen today, but I say 100 years, it's not that long ago, and it could happen tomorrow. So this is the kind of thing people are not ready for.
Do you think that, do you think we're getting closer on the arc? I mean, with this gyration, I'll just say that I'm looking at the stock market, and I'm not a stock picker, I'm not a stock investor, but, down 275, up 275, down 300. I mean, wow. I mean, it just looks like it's whipsawing in a bizarre way. What do you make of that? Does that mean anything to you? Does that mean we're getting closer to the snowflake moment?
Sure. I mean, I've talked about it for years, Greg. I call it NDV, or non-directional volatility. And the reason for it is everybody wants to be on one side of the debate or the other. Everyone falls into these false dichotomies and binary logic. People people worry about inflation. The Fed printed $4 trillion. We're going to get inflation. Buy some gold, get ready, here it comes. And then, guys like Paul Krugman laugh at that and say, look at the price indices. There's no inflation anywhere to be found. Actually, you ought to worry about deflation. Christine Lagarde and Janet Yellen have talked about deflation. Some of the Federal Reserve Bank presidents have talked about it. And one of the reasons I don't think they're going to raise rates next year, in fact, I'm quite sure they're not, we might even go to QE4, is because the Fed's more worried about deflation. Mario Draghi in Europe has spoken about deflation as one of the reasons he's prepared to act. So you've got the inflation crowd, and you've got the deflation crowd. What I try to explain to people is you have to take these two opposite ideas and process them at the same time. F. Scott Fitzgerald said the sign of a first-rate intelligence is the ability to hold two opposed ideas in mind at the same time and still retain the ability to function. And I think that's right. You've got to have both ideas in your head at the same time. By the way, the guy who understands this is Warren Buffett. Look at what Warren Buffett's actually doing. Forget about what he says on TV. Look at what he's actually doing. He went out over the last several years and bought the hardest of the hard assets. He bought a railroad, which is all hard assets. A railroad makes money moving hard assets. He bought Suncor, which is oil and natural gas. He just bought a large network of auto assets. Autos are a hard asset. It's a real thing you drive around. Okay, so that's getting ready for the inflation. Those assets will do very well in inflation. But he's also sitting on $55 billion of cash, the most cash that Berkshire Hathaway has ever had, about 20% of their total portfolio. Cash is a deflation hedge. So what Warren Buffett's saying, okay, and I agree with him. I mean, he's right. He says, I'm not smart enough to know if it's going to be inflation or deflation. The smart money knows that it could be either one. So you need to prepare for both. So have your hard asset portfolio. Most of us can't afford to buy a railroad or a Picasso, but we can afford some gold or silver. That'll serve just as well. But also have some cash. That's your deflation hedge. But people can't process this. They want to be cheerleaders. They want to get their pom-poms out. They want to be over here or over here. They want to be on one side or the other. The ability to process both vectors and be prepared for both, which is what you have to be, is very, very difficult. But that's what investors need to do.
And you know what? One of the things that I have noticed from talking to people like you, I've talked to a lot of people, Lawrence Kotlikoff, John Williams, Jim Sinclair. I mean, you know what? Everybody says one thing, that whether it's inflation or deflation or what it actually looks like or when it happens, everybody says the same thing. It's a mathematical certainty. We're going to have a crash. We're going to have a big financial calamity. Do you agree with that? No matter what, we're going to have a financial calamity.
Well, I completely agree with that, but I could take it further. And again, I can kind of show you the equations, do it scientifically based on my models, which are not, I didn't invent these models. They've been around for about 60 years. It's complexity theory. I'm just taking it and bringing it over to finance and using it to understand a different complex system. But yeah, no, it is a certainty. But what I've discovered that you don't hear is that it will be exponentially larger than any financial panic in the past. And then take it further and say, well, okay, what are the implications of that? So let's go back in time. Let's go back to 1998. Long-term capital management, and I was involved with that, by the way. That was a hedge fund that was failing, but it threatened to destroy the entire global financial system. People, it seems like long ago, far away. The amounts involved were not nearly as large as what happened in 2008. People sort of dismissed it, but I had a front row seat. I negotiated that bailout. I was on the phone with, whether it was John Corzine at Goldman Sachs or the president of the Federal Reserve Bank of New York. I mean, these are the people I was talking with day and night. We didn't sleep for 5 days putting this bailout package together. We were hours away from shutting every financial market in the world when we got that bailout done. Now, that was Wall Street bailing out a hedge fund. Now, come forward 10 years to 2008, it wasn't a hedge fund that was failing. It was Wall Street that was failing. Who bailed them out? The central banks, the Federal Reserve. The Federal Reserve printed or guaranteed tens and scores of trillions of dollars of money and liabilities and money market funds and bank deposits, et cetera. So now let's go forward 10 years from there, say to 2018 or maybe sooner, 2016, 2017. So in 98, Wall Street bailed out a hedge fund. In 2008, the Fed bailed out Wall Street. The next time, it's going to be the Fed that's in trouble. The central banks are going to be insolvent. They're already insolvent on a market-to-market basis. Who's going to bail them out? In other words, each bailout gets bigger than the one before. And using complexity theory, we know that they get exponentially bigger. So the next bailout, the Fed's got a 10-foot seawall, and we're going to have a 50-foot tsunami. It's going to be bigger than the Fed, bigger than the central banks. So who's bigger than the central banks? The IMF. The IMF, International Monetary Fund, is the only clean balance sheet in the world. They can print money. That's a special drawing right, SDR. It's a geeky name, but it is world money. It's the only way to understand it. And they will print 4 or 5 trillion of SDRs. Now, an SDR has a valuation of about $1.50. It fluctuates. It's like any cross rate. But today, the SDR dollar cross rate is about $1.50. And so, say 5 trillion SDRs is $7.5 trillion equivalent, but it won't be dollars. That's the point. It'll be SDRs. Now, it'll be handed out to the members of the IMF, which are basically all the countries in the world practically, and they'll put it in their reserves. And then the IMF, people don't know this, but the IMF has a trading desk inside the IMF where you can swap SDRs. So it's like somebody like China has a bid for SDRs because they want to diversify out of the dollar. A smaller member like Hungary might say, well, we need dollars because we actually need to buy Swiss franc spot to pay off the Swiss banks who lent money to our people who were taking out Swiss franc mortgages. So you can actually, Hungary can call up the desk, say, what am I bid for SDRs? China puts in a bid. Next thing you know, the SDRs are on the way to China, and China's sending dollars to Hungary, and Hungary buys Swiss franc spot and pays off their debts. So that's already going on, by the way. This is not the future. This is happening. If you look at, here's a way to tell. Look at China's all the SDRs that China has received from the IMF in the past. And then look at China's reserve positions to how many SDRs they have today. They have more than they have been allocated, which means they had to buy the rest. in the swap market that the IMF runs inside the IMF is all totally secret. They don't want to be transparent about it. But so the market already exists. All they have to do is push the pedal to the metal and print up 4 or 5 trillion SDRs. What does that mean for the dollar? What does that mean for inflation? See, people just get locked in. They get one idea in their head, and they just sort of put a stake in the ground, and they get all spun up and get their blood pressure up. You have to be calm. You have to just go step by step by step and see how this plays out. And where it's all leading is hyperinflation.
And the dollar, what that would mean to the dollar is it would be severely devalued against the special drawing rights currency, the world currency, correct?
Absolutely.
And you've said also...
And there's
Go ahead.
Sorry, I was going to say there's a dollar SDR question, but the interesting thing about it, Greg, is that, you know, if you had hyperinflation in dollars today when the dollar is still the dominant reserve currency, people would go, you know, burn down the Fed. They'd be protesting and up in arms. But if it's coming from the IMF, I mean, people don't even know where the IMF is.
Washington.
I mean, they're on 19th Street. Yeah, they're in Washington. They're on 19th Street. You know, but most people aren't. They know where the Fed is. Can anyone conjure up an image of the IMF headquarters building? And most people can't. So my point being, the Americans would blame Congress and blame the White House and blame the Fed, and they would say, "Oh, it's not us. You know, it's those guys over there on 19th Street. You know, they'd probably be on the plane to Geneva by then." My point is, it gets so opaque and so attenuated and so geeky and so hard to understand that people won't even know where the inflation is coming from until it's too late.
And one last thing I wanted to touch on too, because you're thinking on these multi-levels and different ideas. A lot of people think, oh, the yuan's going to be gold back, and it's going to be a gold back currency. And that's not what you think. You think they're just simply hedging themselves against the dollar, and it's not going to be. They just want a better position with SDRs in the future.
Well, they're right. They're buying insurance, which is what I recommend for. That's why I recommend kind of 5% gold. That's your insurance. If it's good enough for China, it's good enough for me. In other words, the Chinese are buying thousands of tons of gold, not scores, not hundreds, but thousands of tons of gold. Now, why are they doing that? Either they're stupid or they see something that most people don't. Well, I have a lot of experience in China. They're not stupid. So therefore, they see something most people don't. And that's why they're piling it up. And I think every investor should have some. Now, the popular, the kind of, bloggy interpretation is they're going to come out with a gold-backed reserve currency. Well, China is not even close to having a reserve currency. People don't understand what a reserve currency is. There's a difference between a trade currency and a reserve currency. China is making great strides as a trade currency. It is true that they're doing swaps with countries. They're creating a yuan payment system. Other countries are beginning to accept the yuan and trade. So the yuan is expanding as a trade currency. But to be a reserve currency, you need investable assets. I mean, what is a reserve? It's your savings. So, if you make $100,000 a year and you spend $90,000, you've got $10,000 of savings left over at the end of the year. You can stick it in the bank, or you can buy stocks, or you invested in something. Well, it's no different for a country. Your reserve position is just your savings account. If you export a certain amount, import a certain amount, you export more than you import, and you have other direct capital flows, you're going to build up reserves. Well, you can't put them under your bed. You got to invest in something. Well, the only liquid securities market deep enough and big enough to absorb that amount of global savings, that amount of global reserves, is the U.S. Treasury market. That's why everyone's in U.S. Treasuries. So what would it take to make the yuan a reserve currency? Well, you need a Chinese sovereign bond market to nominate it in yuan. Well, it doesn't exist. And you not only need a bond market, you need issues in all maturities from 30 days to 30 years. You need dealers to make a market in it. You need a payment and settlement system. You need futures and options so you can hedge it. You need repo so you can finance it. In other words, you need all the architecture and the plumbing, as I call it, of the U.S. Treasury market. It will take at least 10 years, possibly 20 years to build that. And even if you did, China's still not equipped because there's no rule of law. I mean, you're not going to do any of this unless you have some confidence that contracts can be enforced, and communists don't believe in the rule of law. So China's not ready to be a reserve currency anytime soon. But here's what they are doing, Greg, and it goes back to the SDR discussions. These secret conversations are taking place as we speak at the IMF meeting in Washington on this weekend in October. China wants to get the yuan in the SDR. Remember I said the SDR is computed with reference to a list of currencies. It's not backed by the currencies, by the way. It's not backed by anything, but the value is computed with reference to the currencies. Now, the IMF has the ability to change that computation. Right now, the currencies related to the SDR are the dollar, the euro, the yen, the Swiss franc, British sterling, might be one or two others, the ones you would expect. If you can put the yuan in the calculation, this is a backdoor way for China to be a reserve currency. They want to have it both ways. They want to have reserve currency clout which they would get from the SDR, but they don't want to open their capital account in the way I described with all the, the bonds and the futures and options and all that. So China is kind of cozying up to the SDR, saying, hey, include us in the SDR. That gives them respect and clout as a reserve currency without actually being one. Meanwhile, they're piling up the gold, not to have a gold-backed currency, but to hedge their dollar position, because if we were to inflate the dollar 10%, China has $3 trillion of dollar-denominated securities, right? 10% inflation on those dollars is a $300 billion wealth transfer from China to the United States. Because this is how the U.S. pays its debts. We just say, hey, we owe you $4 trillion or $3 trillion or whatever. Here's your $3 trillion. Good luck buying a loaf of bread. In other words, we're going to inflate our way out of it. That's obvious. Now, China, you say, well, why isn't China dump the treasuries? Well, the answer is they can't. The market's not that big, and the U.S. can stop them. But what they can do is build up a pile of gold. So they got a big pile of paper and a big pile of gold. If the paper's stable, the gold might not do very much, and the Chinese are happy with that because they'll collect on their debts. But if we take away the value of the dollar by inflation, the gold will go up. So they'll have a hedged position. So they'll preserve their wealth with gold. That's what I recommend for everyday investors.
Ah, yes. Thank you for explaining that. And so right now, do you think things will stay stable throughout the end of the year, or you just don't know? It could happen in 3 years. It could happen in 3 minutes, the snowflake moment.
Why wait, Greg? I mean, it could be 3 years or 3 minutes. That's exactly right. So I don't really see the point in waiting. I like to position now. So I think that's the best advice for investors. So it's been great talking to you. Really enjoyed the interview, and
Yes.
Hopefully the listeners and viewers will enjoy it as well.
Okay, thanks for being on USAWatchdog.com. James Rickards, again, the best-selling book, the author of the best-selling book, The Death of Money, right here, James Rickards. Thank you, sir, for coming to us from Connecticut. Really appreciate it.
Thank you, Greg.